How I invest in stocks without losing sleep or money. Risk-free investing in the stock market? Sounds like a fantasy, right? Like eating 5 pizzas and still losing weight? Well, stick around, because today we're diving into how you can invest in the stock market with minimal to zero risk. If you play it smart, stay patient, and understand the rules of the game. Hey everyone, welcome back to the channel that turns complex money talk into simple, bite-sized chunks of pure motivation and practical insight. If you've ever looked at the stock market like it's a jungle of graphs, stress, and jargon, you're not alone. But what if I told you that there is a way to dip your toe in without losing your sock? Today's topic: how to invest in the stock market without any risk. Yes, without risking your shirt, your sleep, or your savings. And no, this isn't a get-rich-quick pitch. This is about real strategy, long-term mindset, and a few tricks that seasoned investors don't always tell you. Part 1. Let's redefine risk. First things first, let's get real. There's no such thing as zero risk in the stock market, unless you're investing monopoly money. But, and this is important, risk isn't just about losing money. Risk is about not knowing what you're doing. So when people say, the stock market is risky, what they often mean is, I don't understand it yet. Imagine 2 people. Person A invests in a trending stock because TikTok said so. Person B invests in an index fund after studying market behavior and diversifying. Who's at more risk? That's right, not the market. It's the mindset. Part 2. Low-risk strategies that actually work. Now, let's talk how. Here are the smart, low-risk ways to invest that feel almost boring, but quietly build wealth. 1. Start with index funds. They're like the Netflix of investing. Set it, forget it, and still enjoy the show. Real-life example, Warren Buffett himself recommends S&P 500 index funds for the average investor. Why? Because they mirror the whole market. If the entire US economy collapses, well, you've got bigger problems than your portfolio. Tip: start with low-cost ETFs, exchange-traded funds, like VOO or SPY. They spread your money across hundreds of companies. 2. Dollar cost averaging, DCA. Sounds fancy, but it's just a smart way of saying, invest small amounts regularly. Imagine buying $100 of stocks every month. Sometimes the price is high, sometimes low. But over time, you get the average cost. You don't need to time the market. Because let's be honest, even professional traders get that wrong. You trying to time the market is like me trying to guess what my wife wants for dinner. Dangerous territory. 3. Invest only what you can afford to forget. Rule of thumb: if you're gonna need that money in the next 6 to 12 months, it has no business being in stocks. That's your rent, not your retirement. Set aside an emergency fund first, at least 3 to 6 months of living expenses, and invest only what you can let grow for the long haul. Stick to blue chip stocks. These are the Apples, Microsofts, Coca-Colas of the world. Giants with strong balance sheets and loyal customers. Low volatility, high reliability. They're not flashy, but they won't ghost you like that crypto coin you bought at 2 a.m. 5. Dividend investing. Getting paid to wait. Dividends are your reward for being patient. Some companies pay you a share of their profits regularly. Think of it as the stock market saying, thanks for trusting me. Here's a little something every quarter. Example: Coca-Cola has paid increasing dividends for over 60 years. That's longer than most marriages. Part 3. The hidden risk most people miss. Let me tell you something ironic. The biggest risk isn't losing money, it's doing nothing with it. Inflation eats your savings like termites in a wooden house. If you're not investing, your money is literally shrinking every year. So doing nothing is the riskiest thing of all. Part 4. The mindset of the low-risk investor. Now let's shift gears. Let's talk mindset, because wealth starts upstairs before it shows up in your bank account. Successful investors don't panic, they plan. They don't chase trends. They trust time. They don't check their stocks daily. They check their habits. When the market drops, think of it like a sale at your favorite store. Would you freak out if your favorite sneakers were 20% off? No, you'd buy more. Same goes for investing. Discounts are opportunities in disguise. Conclusion: the quiet path to wealth. If you're looking for excitement, go skydiving. If you're looking for financial freedom, invest wisely, consistently, and patiently. Let's recap. Understand what risk really means. Use index funds and ETFs. Apply dollar-cost averaging. Only invest what you won't need soon. Stick to strong, reliable companies. Reinvest dividends. And above all, keep a long-term mindset. If you learned something today, even one golden nugget, hit that like button so YouTube knows this is content worth spreading. And if you want more simple, smart money videos without the fluff, subscribe and turn on that bell, because the next video might just change your financial future.